In this lecture, we'll learn about mutual funds and other investment companies. By the end of this lesson, you'll understand the appeal of these institutions for people like us. And I'm betting you'll like what you see. Why do I think you'll like them? Partly because they offer diversification at low cost, and partly because they're just so darn convenient, especially for people just getting a start on building their portfolio. The idea behind a mutual fund is that although you may not have a lot of money to invest, and your brother Alan doesn't have a lot of money to invest, and somebody you've never met in Nevada doesn't have a lot of money to invest, if we can get enough of us to pool our funds, then we can do a lot more together than we can do individually. We'll all throw our money into a pot, buy stuff with the money, and then we'll share the proceeds depending on how much each of us contributed. We'll be able to buy lots and lots of different stocks so that we'll all be diversified. If we want to hire a professional money manager, then we can do that if we each chip in maybe 1% of our investments. We'll save on research costs for analysts because we're buying many stocks. You see, if we have just one stock, then we may need an analyst to research that stock for us. But if there are 20 stocks in an industry, then we don't need 20 analysts to follow that industry. That's because when someone studies, say, McDonald's, he has to learn about its competitors, like Burger King, too. As a result, we certainly don't need an analyst for every single fast food stock. We'll save on administration and record keeping, too. Mechanical tasks, such as distributing dividend payments and corporate mailings, can be fully automated. We can easily reinvest any distributions we want, or we can take the cash if we want. It's just as easy for the fund to keep track of 1 million people's capital gains and dividends for the IRS as it is to keep track of 1,000. Thanks to automation, we'll even be able to hold a fraction of a share in a company. The fund might own 1 million shares of General Motors stock, and my money might buy 1.4 shares of those 1 million shares. That's no problem. The rest of the fund owns 999,998.6 shares divided among everyone else, depending on how much each of them invested. It's easy for a computer. Because we'll be buying large blocks of stock, the commissions we pay will be smaller. Economies of scale allow for reduced transactions costs and lower fees. We'll see that they may not be as low as they ought to be, but they're lower than people like us can get on our own. We'll have simpler record keeping too. All of our investments will be with one financial institution, and all of our information will come on one statement that's a lot simpler than it would be with 50 different stocks listed. Yes, there's a lot to like about mutual funds. Mutual funds aren't new. In fact, they're downright old. Kurt Rowenhorst of the Yale School of Management reports that a Dutch merchant and broker named Abraham van Kettwich started a fund that he named Eendracht maakt macht, which means unity creates strength. That was way back in 1774. Want to guess why 1774? Holland suffered a financial crisis during the previous 2 years, and van Kettwich's goal was to give small investors a way to diversify and spread risk. The idea of pooling funds to allow diversification is an old one indeed. Van Kettwich's fund invested throughout much of the developed world. Rowenhorst lists Austria, Denmark, Germany, Spain, Sweden, Russia, and even colonial plantations in Central and South America. The key innovation of van Kettwich's fund was the pooling of resources and diversification, not what the fund held. The fund didn't actually hold stocks. Van Kettwich's investments were more along the line of bonds and merchant banking, that is, direct investments in business and trade rather than shares of a company. Not too much else happened with mutual funds until the middle of the 19th century, when a Swiss fund started in 1849. In 1868, Britain's Foreign and Colonial Government Trust became the first mutual fund in an Anglo-Saxon country, and other funds popped up in Scotland in the 1880s. The idea of pooling funds from many investors to buy a diversified portfolio crossed the Atlantic in 1893, when the Boston Personal Property Trust became the first mutual fund in the U.S. 1928 was a big year for fund innovation. The firm of Scudder, Stevens, and Clark launched the first known no-load fund that year. That meant that investors didn't have to pay an upfront fee. The first mutual fund to hold stocks and bonds instead of merchant banking investments, the Wellington Fund, got its start in 1928 too. During the Great Depression, the federal government began to regulate the mutual fund industry. The Securities and Exchange Commission was formed in 1934, and mutual funds were required to register with the SEC and to provide a prospectus. The regulatory web got tighter with the Investment Company Act of 1940, which added more disclosure requirements and took a stab at the worthy goal of reducing conflicts of interest. In the year 1971, two guys from Wells Fargo Bank broke the mutual fund mold. William Faust and John McCowan established a $6 million fund for the Samsonite Corporation's pension program. Their revolutionary idea was that this fund wouldn't try to beat the market. These guys weren't interested in running up transactions costs trying to pick winners and losers. They wanted to match the market return while paying rock-bottom expenses. They didn't even do any security analysis. They just invested an equal dollar amount in each of the 1,500 or so stocks comprising the New York Stock Exchange Index. That way, they earned what the market earned and paid lower transactions costs than other funds paid. Investing hasn't been the same since. Because mutual stock funds hold a diverse collection of stocks, their returns typically track the stock market. They produced amazing returns during the sustained bull markets in the 1980s and 90s. People took notice and mutual fund investments hit record highs. With the exception of a few years around market downturns, mutual funds have been growing ever since. We can classify mutual funds along several dimensions. Some mutual funds invest in stocks, while others invest in bonds. You may have heard of money market mutual funds. I tend to think of those highly popular funds as a special class of bond funds that invest in very short-term debt securities, such as treasury bills or bank certificates of deposit. We'll focus on stock funds, which invest primarily in stocks, keeping just a little in cash and short-term assets to enable redemptions and other needs for quick cash. You can further partition stock funds into domestic stock funds and international stock funds, which consist of global funds, international or foreign funds, emerging market funds, and probably a dozen other types. The definitions of these funds aren't etched in stone, but typically a global fund invests anywhere in the world, while an international fund, sometimes called a foreign fund, excludes the fund's home country. The definition of an emerging market fund is fuzzier. First, you have to define an emerging market, and reasonable people will disagree. Generally, though, these countries tend to be poorer and rapidly growing with more political and economic uncertainty. Emerging markets funds usually offer the potential for higher returns, but obviously higher risk is part of the bargain. Still another way to classify mutual funds is by their investment policy. Each mutual fund has a stated goal, often depending on the amount of risk they'll take in search of higher returns. Among the most popular categories, income funds, which hold a lot of mature companies that pay big dividends but don't offer much hope for big price increases, are the safest. Growth and income funds come next, then growth funds, and then aggressive growth funds are the riskiest. They tend to hold stocks in smaller companies, companies that have fallen on hard times but hold some promise for a big recovery, and companies in risky industries like biotech. You can also classify mutual funds as taxable or tax-exempt. Most tax-exempt funds hold lots of municipal securities. You won't find a tax-exempt stock fund, but some explicitly state that although their main goal is to earn a good return, They also make a serious effort to minimize the tax bill that Uncle Sam sends you every year. They use some tried and true methods to take a decent bite out of your tax bill. Mutual funds are either closed-end or open-end. If you want to own shares in a closed-end fund, then you buy them on a stock exchange or on NASDAQ just as you would shares of a company. You can't buy any more shares from a closed fund because it's closed. That means that the mutual fund isn't involved in these transactions other than recording the ownership change on its records. Open-end funds are different. Investors don't trade them on an exchange as they do regular stocks. Instead, shares are bought from the fund and redeemed by the fund. Most funds these days are open-end. That's partly because they can easily grow if management does a good job and attracts new investments. An open-end fund just issues new shares in exchange for new funds, which it then invests. Closed-end funds can't do that. Fund managers like asset growth because the bigger the fund, the bigger their fees. But investors benefit from an open-end fund too. It's easy to buy and redeem shares at very low cost. One thing that's unusual about open-end fund is the way that the price is set. Because the shares in an open-end fund aren't traded on a stock exchange, you can't get a market price that way. What you can do, though, is calculate the value of a share from the securities in the fund. The result is the net asset value, which is essentially a weighted average of the prices of the securities in the fund. Take the total value of all of the securities and other assets the fund owns, subtract the value of anything the fund owes, and divide the result by the number of shares. To illustrate, let's take a tiny fund that owns just 10 shares of stock, each worth $50. That's $500. Add, say, $10 in cash the fund also has, and subtract $5 the fund owes to stock analysts, and we're left with $505 in total value. Because the fund has issued 10 shares, each of those shares is worth $505 divided by 10, or $50.50. That's the net asset value. Funds calculate the net asset value every business day, and all purchases and sales are at the end of the day at net asset value. Of all the ways to classify mutual funds, though, to me, the most important way is by the way they're managed. Some are actively managed. That means that professional money managers research stocks to try to find undervalued securities to buy for the fund, and they sell stocks that they think are likely to be underperformers. Other funds, the passively managed ones, are built around the efficient market hypothesis we met in Lecture 7. The idea is that if stock prices are fair bets, then what's the point of spending time and money trying to find winners and losers? Investors in passively managed portfolios agree that trying to pick winners is a bad idea, so they choose a fund that's designed to replicate the performance of an index, like the S&P 500. The idea behind these index funds is simple. The goal is that the investors in the fund take the average return, less the cost of running the fund, of course. But those costs are much lower than they would be for an actively managed fund, because an index fund doesn't need security analysts and doesn't run up large transactions costs. The growth of index funds has been impressive. Burton Malkiel, the longtime professor of economics at Princeton University, says that index mutual funds now hold about a third of total mutual fund assets. Malkiel gives evidence that outperforming is well nigh impossible. The data show it's been that way for decades. Over long periods, benchmark indexes beat about 2/3 of active managers. And the chance of picking a fund from the 1/3 that beats the index is harder than it sounds. That's because the funds that outperform the passive index in one period usually don't repeat their success in the next one. I'm not going to tell you that everybody accepts indexing as the way to go. Index funds have never been popular in some circles and never will be. Lots of investors just can't stand the thought of taking the average result. It's only natural to want to beat everyone else, isn't it? People like to win. Navy football coach Eddie Erdelatz said, "A tie is like kissing your sister," after a scoreless tie against Duke in 1953. Lots of people feel that taking the average return is like that. For their part, most Wall Street firms would just as soon have index funds simply go away. There's not much money to be made managing index funds. There's a reason for the old adage that advice about index funds is the best investment advice you'll never get. Critics also say that index funds focus on big firms and therefore lack diversification. That's partly true, but it's also unfair. Index funds are just reflecting the actual market. You can wish that the market wasn't dominated by big firms, but that won't change anything. To illustrate, the S&P 500, which represents about 3/4 of the U.S. stock market's value, it usually has about 1/4 of its market value in just 10 or so firms. The market really is dominated by a few big firms. So if you want to track the market, then your portfolio will be dominated by a few big firms too. Professor Malkiel, an avid supporter of indexing, says, "You can't control what markets can do, but you can control the costs you pay." Of course, no mutual fund is completely free of costs. In fact, mutual funds are subject to several different types of fees. Not all funds have all of these fees, and you should always ask the people at the funds exactly what fees you'll pay. Among the most visible fees are load charges. You pay a front-end load when you buy shares in the fund and a back-end load when you sell them. Back-end loads are often called redemption fees or sometimes a deferred sales charge. It's pretty common for deferred sales charges to decline or vanish if you hold the shares long enough. Personally, I never buy a fund with a load charge unless it'll vanish within a couple of years. That type of load won't hurt investors who hold shares long term. You can make the case that investors who plan to hold the fund for a long time would benefit by paying a relatively large amount up front in exchange for lower annual fees along the way. Put that way, a front-end load charge is a way to attract long-term investors. I'd feel better about that line of reasoning if there weren't no-load funds with annual fees that are just as low as funds with load charges. All funds incur operating expenses too. They pay commissions when they buy or sell shares. They have to pay administrative expenses and overhead. The light bill doesn't pay itself. And the managers have to make a living too. Even index funds incur these costs, although they're lots lower than they are in an actively managed fund. I don't want you to obsess about a particular type of fee. My take is that you can call a fee whatever you want. I want the fund to add up all of those fees, whatever their names, and tell me how much it is as a percentage of assets. All else equal, I want that number to be as low as possible because fees come out of returns. If the fees don't lead to higher returns to cover their costs, then I'd just as soon do without them. Let's get a sense of the size of fund fees. What's a fair comparison? Professor Malkiel says that fees for actively managed funds look small as a percentage of assets. Put that way, total fees average less than 1%. But Malkiel points out that compared to annual stock returns of, say, 6% or 7%, that 1% fee is about 15% of your portfolio return. Malkiel goes even farther. He argues that the correct comparison is between fees and the extra returns that the active managers earn through shrewd investing. If a manager earns an extra 2% by picking the right stocks, then a 1% fee still leaves me 1% ahead. That's a fee I wouldn't mind paying. The trouble is that these extra returns seem to be somewhere between tiny and non-existent. Viewed that way, the extra expense of active management is a huge mostly deadweight loss to investors. If I asked you to guess how mutual funds perform on average compared to overall stock returns, you probably could make a good guess. Some of you would think, financial markets are pretty darn efficient, and it's hard to pick winners. I'd guess that before fees, mutual funds earn just about the same amount as the overall market. Some of you would come at the problem from a different direction, but you'd get the same answer. You'd think U.S. mutual funds hold around $15 trillion in total assets. That's a big part of the entire U.S. market, so mutual funds can't possibly earn too much more or less than the entire market. And you'll all be right. The gross returns on mutual funds are just about the average return for the entire market. After deducting the costs of operating the funds, mutual funds have no free lunch either, they fall a little short of the overall market. If you compare the performance of the average actively managed mutual fund against an index fund designed to track the overall market from 1970 through 2008, you'll find that the active fund wins maybe 15 times and the index fund wins a few more than 20 times, with the rest too close to worry about. Professor John Cochran of the University of Chicago isn't surprised that we continue to see mediocre results from actively managed funds. A small number of managers might be really good. They're the Picassos of the investing industry. But the average artist isn't all that good, is he? Why should it be different for money managers? What we really want to know is how to identify those outstanding managers and get in on the deal. And that's a problem. Professor Malkiel has shown that there is very little consistency in terms of which managers achieve superior results in any given period. The guy that beat the market by a lot this year probably didn't beat it by a lot last year, and the odds are good that he won't beat it by very much next year either. In fact, according to most research, whatever consistency we find across time is that funds with high fees generate fairly persistent bad results. Nobody seems to be able to pick enough winners over even just a few years to overcome high fees. If that's the case, though, then how can all of those brokerage firms and mutual funds advertise that they outperform the market? They can do this for the same reason that every single car company can claim to be the best. Nissan might claim to have the most horsepower. Toyota might counter with the best customer satisfaction. Honda chimes in with, what? Maybe it has the best resale value. Perhaps Ford touts best-in-class fuel economy. Funds do the same thing. Every active fund can find a time period when it beat some index, and that's what you're going to be hearing from them. You can probably tell that I'm a big fan of mutual funds, especially index funds. Toward the end of the 20th century, an upstart started to crowd into the mutual funds territory. The Toronto Stock Exchange, or the TSE for short, gave birth to this new kid in March of 1990. Named the Toronto Index Participation Fund, and usually called the TIP 35 or just TIPS, this exchange-traded fund, or ETF, let investors like us buy a single security that tracked the TSE 35 composite index. Like an index mutual fund, this ETF was designed to match the returns of the index. But unlike a mutual fund, you bought and sold the ETF on an exchange, just like an ordinary stock. That's why it's called an exchange-traded fund. The first U.S.-traded ETF was the Standard & Poor's 500 Depositary Receipt. These SPDRs, pronounced spiders of course, appeared in 1993. Asia came on board in 1999 with the Hong Kong Tracker Fund, and Europe's Eurostoxx 50 market ETF appeared in 2001. ETF growth has been phenomenal. According to the Investment Company Institute and Investment Fund Trade Group, ETF assets grew from just a few $1 billion in 1998 to nearly $600 billion in the US alone by 2007, and then more than doubled from 2008 to 2013 to $1.4 trillion. What fueled this phenomenal growth? ETFs offer most of the advantages of a low-cost index fund, plus a few tidbits that mutual funds can't match. Let's go down the list. First, ETFs let a small investor buy a highly diversified asset that pretty much guarantees him the market return while offering extremely low expense fees. Some ETFs track a broad market index. Some target much more narrow industries, trading diversification for the chance to take greater risks if an investor wants to bet on a specific niche. Of course, just like a mutual fund that focuses on a narrow market sector, an ETF designed to move with a narrow sector exposes you to more risk. When the financial sector crashed in 2008, the most popular ETF for financial stocks, the Financial Select Sector SPDR, lost about 3/4 of its value. The broader market took major losses too, but not to the tune of 75%. If you decide that you want to roll the dice, then you can even buy a leveraged ETF. The ETF's management borrows money and buys more stocks. It's like buying on margin, except that it happens within the fund instead of you doing it yourself. Some ETFs are designed to move twice as much as their index, or even more. That means that a 1% increase in the S&P 500 will result in a 2 or 3% increase in your ETF. If you think that's too good to be true, then you're right. There's a downside to leverage. A loss gets multiplied too. A market loss of 1% will mean a 2% loss for you. That doesn't sound like nearly as much fun, does it? Levered ETFs aren't necessarily bad, mind you, but you need to know what you're getting. ETFs can outperform an index fund as often as not because they have reduced levels of what the street calls cost of flow. Cost of flow is the expense of providing shareholder liquidity by moving mutual fund shareholders into and out of the fund. Academic research shows that cost of flow can hurt a mutual fund's performance by as much as 0.5 percentage point or more annually. ETFs don't incur the costs of fund redemptions. Investors just buy or sell their shares on the open market. Because ETFs trade like equities, investors can use some of the special types of trading tools we discussed in Lecture 9, such as stop loss and limit orders, short sales, and margin purchases. You can't do that with a mutual fund. Some ETFs even offer options trading. If you decide to buy or sell at, say, noon, and you think the prices will move against you during the rest of the day, you can make your trade immediately with an ETF because they trade throughout the day. With a mutual fund, you have to wait for the end of the day so that the fund can compute net asset value. ETFs might have a lower tax bite too. Investors in both ETFs and mutual funds incur taxes in two ways. First, they pay taxes on any gains in the investment at the time of the sale. And second, they pay taxes on any capital gain that the fund distributes to you. The second point is how an ETF and a mutual fund may differ. Compared to an actively managed index fund, ETFs usually distribute capital gains less often than mutual funds. It's worth mentioning that all stock mutual fund distributions are taxable, even if reinvested in the fund. I don't buy a fund of any sort just before its distribution date, usually near the end of the year or quarter. The fund will take your money, turn around and give you some of it back almost immediately, and then you get a tax bill. Bad idea. ETFs aren't perfect. They do have their drawbacks. Buying or selling ETFs will cost you more than getting into and out of a mutual fund because you'll usually pay a brokerage commission or a bid-ask spread. Some ETFs don't trade much, relatively speaking, so the commission or bid-ask spread might be bigger than you'd like. If you think you'll be trading your ETFs more than a couple times a year, then a mutual fund will probably be a better choice. We've only scratched the surface of the huge world of mutual funds and investment companies. If you'd like to learn more, you'll find tons of information. Your biggest task won't be finding it. It'll be sifting through it and making sense out of it. The web is a great resource. A good place to start is Morningstar. Morningstar is known for its fund ratings and also offers investment management services. It had almost $160 billion in assets under advisement or management in March 2013, with a footprint in 27 countries. You can learn a lot from the Investment Company Institute, and Yahoo Finance is a great place to visit too. You can find all of them on the web. If you're interested in a specific fund, get yourself a copy of the fund prospectus and a cup of strong coffee. Reading a prospectus isn't for the faint of heart. Don't tell anyone, but I've never read one cover to cover. Instead, I use a prospectus like a dictionary. When I want to know something about a fund, then I go to the prospectus, preferably an electronic copy so I can search it. You can search for keywords like fees or investment objective. In our next lesson, we'll learn two of the best and easiest ways to improve your investment returns: minimizing taxes and transactions costs.